Friday, September 17th, 2021, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at what happened to the price of gold yesterday. There's a lot of comments out there about retail sales driving gold lower. I think that's a very lazy assumption, especially if you watch the gold price very carefully, as I have been since 2002. Yes, of course it was manipulated, and some people will argue if the bullion banks and the central banks manipulate the price of gold, how come it's still going up in the long term? How come they can't keep it down? Well, because they can't keep it down, and I'm going to show you why they manipulate it. It's not to keep the price down, but to keep the general public away from acquiring real physical gold, and I will give you proof that that's the case. And the proof is from just around before gold was legalized again for ownership in the United States in 1975. Before I look into that, I'll just show you the chart yesterday. It's a 30-minute chart. I am in London, so it's a different time zone than when the retail sales number comes out in the US. It comes out at 8:30 a.m. New York time or Eastern time. Here it comes out at 1:30 p.m. London. So I've drawn a little oval here on the bar chart. It's a 30-minute chart. You can see it's 13:30, 16th of September. That's when the number came out. Gold was already below 1770. It had dropped already from above 1790 earlier in the morning in London. So most of the drop had taken place already prior to even comex opening. And the drop we saw after retail sales, yeah, it was fairly significant, but as you can see, it wasn't because of a stronger than expected retail sales. And I think the retail sales number anyway is an anomaly. The US economy, the world economy, the UK economy, they're all going downhill very quickly again. They're going to use this crisis, of course, this health crisis, as an excuse, probably to try to pump things up again. So that's for those people who they just parrot something. Oh, retail sales came out and that's why gold dropped. And that's very focused on just the US market, and people don't understand, a lot of people don't understand that gold is really trading as money and the currency, and it trades 24/7. So you need to go back before the comex opens, before the US numbers come out. So now let's look at why they manipulate the gold price. And it's a WikiLeaks document from December 10th, 1974. On December 31st, 1974, comex started the gold futures contract. Prior to that, there was no gold futures contract, or GC as the mnemonic for the gold futures contract is. And so the document, it says London wholesale gold dealers' views on US gold sale and private US ownership. And London was at the time, of course, the center for gold bullion trading, because you couldn't do it in the US. And I would say that these gold dealers became eventually, they are part of the bullion banks today. So this would be what the bullion banks would be talking about as well nowadays, I would say. So this document is unclassified, limited official use. It's between Economic Affairs, Financial and Monetary Affairs UK, and the United States. So it's a governmental document, and it was declassified by the US Department of State, 30th of June 2005. So Department of State, Secretary of State. So this is very high level stuff. For those of you who think gold is just a pet rock, it's very important to to the system, to the dollar, because if the dollar goes, the whole system goes. So let's go through the whole thing so you get a feel for what they said about 46 years ago, 47 years ago. The announced auction of official gold by the US Treasury was praised by London gold dealers as being timely and highly contributory to a more stable market. So you're going to see what they mean by stable market. They don't mean a market that is not very volatile. And these London gold dealers, they're not the people selling a sovereign here or there for the average Joe out there. They're the dealers who deal for the Bank of England. They were the original bullion banks. The bullion banks, of course, got involved in this business as well. Some fear, however, that should a single bid for the entire 2 million ounces be forthcoming, prices might increase rapidly, possibly as high as $250 an ounce. So you see, that's what they mean by a more stable market. It's capping the price. They couldn't care less if the price dropped to 100. They would be happy with that. They anticipate major impact of U.S. ownership will be the formation of a sizable gold futures market, but rather small demand for physical holding of gold other than coins after a brief initial surge following deregulation. So we're going to continue here. Page 2. In London, to private ownership of gold by Americans, Assistant Financial obtained reactions from major wholesale gold dealers, Samuel Montagu and Co., Sharps Pixley, Makata Goldsmith, and Consolidated Goldfields. Yeah, you can add now the bullion banks to these group of people, and you notice that it's wholesale. To announce auction of gold by U.S. Treasury, while the underlying reasons differed, the consensus of the dealers was that the move by the U.S. was laudable. Of course, they don't want the price going up. They're working for the Bank of England and the big banks. In most cases, they stated that the action was unexpected. The timing of the decision was praised as being foresighted. Announcement of the sale prior to the January 1st, 1975 date was viewed as timely, since there is mounting evidence that much of the recent increase in the price of traded gold has resulted from anticipation of a large American demand following the deregulation date. So that's the 1st of January 1975, when gold became legal again. And it's interesting that the COMEX futures contract was created on the 31st of December 1974. And why would they do that? Well, because it settles the next day, so they could already manipulate the price the day before it became legal again. Even though the dealers themselves expect the physical demand to be rather short-lived. This much can be said, a recurring comment both in conversations with the gold dealers as well as in numerous telephone calls received by the embassy, is that if one buyer, or more likely one buyer from a particular country, Kuwait was often cited, decides to place a bid for the entire 2 million ounces of U.S. gold being auctioned either at market prices or possibly at higher than market prices, then the effect of the U.S. auction, which is initially viewed as having a stabilizing force on market prices. You see, stabilizing doesn't mean stabilizing volatility. It means not letting the price go higher. Would be the opposite. Dealers stated that should such a single bid be accepted by the US, then the markets would interpret this as a signal that heretofore unrecognized demand was present and prices would increase rapidly. They don't want that. Possibly as high as $250 per ounce or even higher. In the dealer's view, the only counteraction to the above hypothetical situation would be for an immediate announcement of an additional sale of like or larger quantities. The dealers with whom we spoke stated that to date there had been no significant activity in the gold markets by official monetary authorities of Arab countries. They also expressed the view that should market conditions indicate that prices may rise rapidly in the near term, a large volume purchase from oil producing area should not be totally discounted or unexpected. While most dealers did not foresee a large Arab demand for gold to be held as official reserves, they did see demand from the oil producing areas, with Middle East residents being potential active traders in the gold market, especially in the absence of official sales to stabilize price. In reply to question, they were not clear whether this type of activity might come from official authorities or only from private sources, but reiterated the idea that the oil producing areas were the only ones with sufficient funds to make large physical gold purchases in current market conditions. So this also shows you why the deal with the Saudis about the petrodollar was so important, because they wanted the Arabs to stay away from physical gold. And this is 1974, right around the time that Kissinger went to Saudi Arabia to broker a deal with the Arabs. So here's the part that I think is very telling about what the bullion banks or the wholesale dealers do to the gold market. This part is entitled "The Major Impact of Private U.S. Ownership." To the dealers' expectations will be the formation of a sizable gold futures market. Each of the dealers expressed the belief that the futures market would be of significant proportion and physical trading would be minuscule by comparison. Also expressed was the expectation that large volume futures dealing would create a highly volatile market. Not stable, volatile. By stability, as I said, they don't like the price higher. In turn, the volatile price movements would diminish the initial demand for physical holding and most likely negate long-term hoarding by U.S. citizens. So this is your own U.S. Treasury, and I'm not having a go at Americans, but this is the U.S. Treasury trying to keep the American public away from gold. Yes, politically, I guess they had to liberate the gold market, but behind the scenes, they were making sure that people didn't get too excited about holding gold, because they want people in the paper, in the fiat currency. As to future demands by U.S. citizens for gold, most dealers did not foresee demand for physical holding as significant. With the exception of an initial surge during the first 2 to 3 months of the year following deregulation, they did not feel that U.S. citizens on the whole were psychologically prepared to switch from small-scale gold coin purchases to large-scale long-term bullion hoarding. Several expressed the view that the demand for coins after the initial surge would most likely be such that it could be met from within should the U.S. decide to mint gold coins for such purposes. So there you go. And I would say ETFs and all the other derivatives on gold are part of this program of discouraging Americans and the public everywhere in the world from owning physical gold. And I remember I went to an FT gold conference in 2009 when I was still working in the city. One of my good colleagues, who's a gold bug as well at MF Global, he got an invitation and he took me along with him. He invited me to go with him. And most of the people there were these wholesale dealers, the bullion banks. And they were going on and on about the ETFs. And I raised my hand and and I wanted to make a comment about how gold sovereigns were great because they're physical and that there is no capital gains tax on it. And they said, oh, yeah, we're not here to advise people on taxes. And they basically shut me up because I was trying to tell people that owning physical gold was a good thing. So you get the idea that that's what happened to gold yesterday. It wasn't because of retail sales. Yeah, even though I think the powers that be wanted to make it seem like, yeah, you don't need gold, everything's fine with the economy. But you notice that gold was down over $20 already prior to the retail sales number. So for those of you who are just new to gold or thinking about buying gold, again, I would say, don't let it discourage you. This is what they want. They want you to think that gold is just another volatile commodity, even though it's the most stable store of value it has been for the last thousands of years. And I would add silver to that equation as well, even though silver is a thinner market. But anyway, with that, let's quickly look at where the markets are this morning. It's just before 9 a.m. London time. And before I start, I did show you that 30-minute chart of gold. Now I want to show you a monthly chart of gold going back over 20 years. So this is how the price still looks. Yes, we're down from the top last year, but it still looks very bullish, I think. And yeah, so the technical picture longer term looks pretty good. Nothing's changed. Yes, a bit of a scare yesterday, if you want to call it that. So where are we this morning? Well, gold is up about $7 at 1760.70. The low has been 1752, the high 1765. Silver is up 4 cents, 22.94. The high has been 23.01, the low 22.80. The Dow futures up 23, NASDAQ futures down 5, S&P future up 1 point. To the currencies, sterling is unchanged, 137.92. The euro is unchanged as well at 117.72. Dollars up 0.2% versus the yen at 109.94. The Aussie dollar is up 1/3% at 73.13. The dollar is down 1/4% versus the Canadian dollar at 126.50, and the Kiwi dollar is unchanged at 70.75. To the general commodities, WTI crude is down 0.5% at 71.97. High-grade copper is up 0.75% at 4.31, and natural gas is down 0.5% at 5.34. So it looks like natural gas has stabilized a little bit. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And make sure you also hit that little notification bell to be notified of all my new videos. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.